Hello traders, welcome back to the Forex Gig, where we dive deep into the tool that can help you make smarter trading decisions. And in today's video, we are going to be talking about the trusting candlestick pattern, a powerful formation that can help you identify potential continuation signals in a downtrend. If you are looking to sharpen your technical analysis skills and improve your trade timing, make sure to watch until the end of this video. By the conclusion of this video, you would know exactly how to spot this pattern, how to understand its market psychology, and use it effectively in your trading strategy. The trusting candlestick pattern is a two candlestick formation that typically appears during a downtrend. It signals a potential continuation of bearish momentum, making it an important tool for traders who want to anticipate future price movement. The pattern begins with a long bearish candle which reflects strong selling pressure in the market. The second candle is bullish and opens below the low of the first candle, as seen from this diagram on my screen. However, despite the bullish nature, it fails to close above the midpoint of the first candle body. This inability to close higher indicates that sellers are still in control, even though buyers attempted to push price upper. This is an example of this is what the pattern shows, and on example of this pattern on the real life chart, and as you can see, this is the pattern where the bearish candle closes and the bullish candle gaps a little bit down and comes up but do not reach the midway point of the bearish candle. The key characteristics of this pattern is the second candle closes below the midway point of the first. This details a crucial because it shows that the bulls' attempt to reverse the trend has been rejected by the bears. The trusting pattern is most effective when it forms within a strong downtrend, and it suggests that the bearish momentum is likely to continue. As you can see, it's formed in a bearish trend, where price was making a series of lower lows, lower highs, lower lows, lower highs, lower lows. This is a bearish trend. Alright, let's see how we can implement this strategy. We first of all identify the pattern. When we identify the pattern on our charts, we identify the pattern to trade the trusting pattern. We start by identifying within a clear downtrend. When it's within a clear downtrend is when we can say yes, we have identified this pattern. We have to look for a long bearish candle that reflects a strong selling pressure. Second bullish candle that opens below the previous close but closes within the lower half of the first candle. This is our pattern in this area. The second step to trying to implement this strategy after identifying this pattern is to confirm the setup. Confirmation is key when trading this pattern. You have to wait for price to break below. After you see this pattern, you wait for price to break below, and once price breaks below the second candle, before entering a short trade, once price break below the second candle is when you enter your short position. This confirmation confirms that sellers are regaining control and the downtrend is likely to continue. So we'll take our sell position when it breaks below the bullish candle. This is how we take it. Then we need to know about our entry confirmation. When entering a short trade, just enter a short trade just below the low of the second candle. After it breaks below the low of the second candle, you enter a short trade. You have to ensure that the overall trend align with the direction by using tools like moving average or trend line. You can decide to use a trend line or moving average to confirm that you are in the direction of the market sentiment. You are in a bearish trend, and as we can see, yes, we are in a bearish direction. After this, we have to know where we are going to set our stop loss, because risk management is crucial. Placing stop loss is very also crucial in taking this strategy. We have to put our stop loss above the high of the first bearish candle in the pattern. We have to put it above the high of the first bearish candle in the pattern. Alternatively, you can place it above a key level of resistance. If it aligns with your bias, you can put it above a key level of resistance as long as it aligns with your bias. We take profits at realistic levels. We set our take profits at realistic levels such as key support levels, areas that price are meant to get to. These are support levels in the market. We set our stop loss, we set our take profit to such levels. We can also set our take profit to 1:2 or 1:3 as the case may be. This is how we set a standard take profit in using this strategy. A risk to reward of at least 1:1.5 or 1:2 to ensure a favourable trade outcome, as seen in this chart on my screen. Alright traders, we have come to the end of this video. Engage with us in the comments below. We want to hear about your experiences. If you found this video helpful, do not forget to like, subscribe and turn on the notification bell so that you wouldn't miss out on more trading tips and strategies. Thanks for watching, and I will see you in the next video.